Hey there, thanks for tuning in. Welcome to Investing in Germany. And today I want to quickly go through the JP Morgan's Guide to Market report submitted for the first quarter of 2023. This is a quarterly report published by JP Morgan, and everybody can have a look at it. And the link to this document, you will find it in the description. So it's a really great document to start with because it gives you the overall picture of how the market is doing all over the world. So it gives you the macroeconomic view and as well as some linkage to the stock market and the valuation metrics and so on. So this really a good document to start with while you are starting your portfolio creation and portfolio strategy creation and so on. So to start with, I want to start with the PMI index. So PMI index is nothing but the Global Purchasing Manager Index, which is nothing but a sort of a survey done on those manufacturing companies all around the world to see how their manufacturing activities are looking, how their order book is looking, how their future forecast is looking, and so on. So it just gives you the manufacturing activities all around the world. So in Germany, it is a really important index because Germany, as you know, is an industrial economy, which means that we are doing a lot of manufacturing, and all the top businesses in Germany is a manufacturing industry or companies like we have Bosch or we have let's say Bayer, BASF, and we also have Volkswagen, Mercedes-Benz, BMW, Henkel. So all the companies here, what we have in Germany are manufacturing companies. So this is a really good index to see how the economy in Germany is doing well. So to interpret the data, index number 50 is nothing but a baseline. So from last month or last quarter to this month, there is not much difference in the manufacturing activities. So everything is the same as last month. And if this goes below 50, then which means that it is not doing well. So there is a contraction in manufacturing activities. And if it is going above 50, then it is really going good. The manufacturing activities is going really good. So in Germany, unfortunately, it is going down by 5.5 index points. And this is a really steep drop, I would say, for the German economy. So if you compare this to the last quarter of last year's GDP data, where we contracted by 0.4 percentage, if this is really true and if this is really going to navigate itself through the GDP data, then I would say that we were actually in recession. So for recession to happen, we need 2 consecutive quarters of degrowth in GDP. If the Germany manufacturing activities are really slowed down like this much, I would say that the GDP was also contracting. So we were actually in recession. Whether we are currently in recession is something that we don't know. And since we are now in April and the March 2023 GDP data should come in like the end of April, I think around 28th of April. So by that time, we will know how the economy was doing in Germany. So let's wait and watch over there. So the headline inflation, this is one of the hottest topic all around the world. As the chart itself says, everything is red for now in February. And it's clear. So almost all the economies around the world have a steady, sticky inflation. So this is one of the reasons why we are also seeing a lot of red points here. In Germany, unfortunately, we are at a really steep high of 8.7%. So if you remember, the target inflation rate for the Germany is 2%, or a matter of fact, also for the Euro area is 2%. And you can see that we are well below, like about 4 times what the target inflation rate is, which means that we have a really, really long journey to go to reach the 2% target inflation rate. So we have to really sit tight over here. And let's have a breakdown on those inflation data for the Eurozone. So most of the inflation is coming in through the food, alcohol, and tobacco. So if the gas prices are high as it is now, then of course the food, alcohol, tobacco will go up because they rely on a lot of transportation. Because for us in Germany, we are importing almost all the foods and stuffs from all over the world. So if the oil prices are at a elevated level, then we will have a really high food inflation. So this is clean, and what is really good to see here is that the inflation coming in due to the electricity and gas has come down thanks to all the measures done by the European policymakers and the governments, where they have gone out and subsidized the gases and the electricity and so on, and also let's say spread out the supply chain. They expanded the supply chain outside of China and Russia. Down they are going all over the world. And it's a really good sign to see that diversification supply chain is coming in. But then for now, we have to really sit tight and see how the next couple of quarters and years are going to be with the high inflation environment. What is really very bad to see for the, let's say, central bankers is because the core inflation is not going down anytime soon. You can see that the headline inflation is coming down thanks to the electricity and gas breaks and all those stuffs that the policymakers are doing. But then the core inflation is something that can be contained only if they're very, very high interest rate, and also to bring down the liquidity in the market. If we are not going to bring down the liquidity in the market, then the core inflation is going to be very, very, very sticky. And that's what we are seeing here. So labor market and inflation is a really, really a good combination to see how the market is going and how the inflation is going to trend out. Unfortunately for Eurozone, the employment data, the labor market data is going in the completely opposite direction what the central bankers would like to see. So to start with, we can see the unemployment is going down. So the relation between unemployment and the inflation is that if the unemployment goes up, the number of people having no job goes up, which means that they are not going to spend, and then the inflation is going to come down. And unfortunately for the Eurozone, the unemployment is coming down. So which means that a lot of people are having a lot of job, and then they are spending more, and therefore the inflation is going up. And then another aspect is also the wage growth inflation. So you can see here the wage growth is also going up, which means that the people who are working are also getting more money in their pockets, which means that they will start spending, and then the inflation will again go up. So unfortunately, both the data is going in the really wrong direction for the central bankers. Of course, this is really good news for the politicians, because this is exactly what they want to see, right? So they want to have really low unemployment. So they want to give a lot of jobs to the people, and also they want to give a lot of money into the hands of the people, so that the people would think that they are doing really well, and therefore the government is doing the right job. Unfortunately for central bankers, this is not the right data point to see, but unfortunately this is how the capitalist society works. And we have to really see how the central bankers are really going to bring up the unemployment and bring down the wage inflation. I would suspect that the interest rate has not reached its peak. I think there'll be another couple of increase in the interest rates based on these data, because of the high inflation, low unemployment, and so on. So let's wait and watch over there. And finally, coming to the metrics and then linking this to our portfolio strategy, which we created recently and which I also presented you recently. So link to that video will be here on this card here. So what we said there was that 40% to the emerging market, 30% to the Berkshire Hathaway, and 30% to the European economy. I said deliberately that I want to stay away from the US economy because they are really, really highly valued. And this is also what you can see here. The US economy is at a highly, I would say it's richly valued. And keep in mind, this is also forward PE. It's not an actual PE. So forward PE is a lot of optimism done by those Wall Street journalists and analysts. So I would say this is the best case scenario. The worst case would be, I think, maybe probably here or even here, the actual. So we have to really wait and watch how it is going to progress for the US. But then for now, I would stay away from the US economy for my savings plan portfolio. And I would stick to the Berkshire Hathaway. If you're looking at the news and the investment news, you would already know that Berkshire Hathaway and Warren Buffett, they are currently in Japan negotiating some deals with the big Japanese trading companies. And this is a really good sign to see, because he is making use of those money, what is lying in his bank account, in Berkshire Hathaway's bank account, into real work. I would really stick to that portfolio to replace the MSCI World with the Berkshire Hathaway, because MSCI World here is a bit richly valued, I would say, and I would really stick to the Berkshire Hathaway, which is going to do really well, because if all those actions are going right in the right direction, then I would say that Berkshire Hathaway has a really good potential to grow. I also said that 30% goes to the European economy. So European economy is also, it's not highly valued. It's also, let's say fairly valued. And also UK is extremely low valued because of all the issues that they have with the Brexit and so on. So but Europe, I would say, is okay valuation. So we can invest as a savings plan into the European Union to get the exposure of the developed economies. And emerging market and China both are undervalued as per here. And I would also say that there is a lot of potential for the Chinese economy as well as for the emerging market economy to do much well. I would say that the current portfolio fits to the current market strategy, what we have. So 40% towards the emerging economy, 30% towards the European economy, and 30% to Berkshire Hathaway. So Berkshire Hathaway is replacing the MSCI World. And I would say that we are in a really good position based on this market data for our portfolio strategy. And let's continue have a look on how the market is performing. So thanks for watching. See you in the next video.